The Dow looking to extend its record run after the Fed voted to hold rates steady in its last meeting of the year. Central bank also putting multiple rate cuts on the table for 2024. The Dow closing above 37,000 for the first time ever after that news, now about 0.33% here. For more on this, we're going to turn to Mike Arone, State Street Global Advisors U.S. Spider Business Chief Investment Strategist. So, Mike, you were listening to that Fed presser yesterday like the two of us were. At least initially, investors, they really loved what they heard, Mike. You saw that euphoria take hold, rallies in the stock and bond markets. Give us your take, Mike. What did you make of what the Fed did and said yesterday?
So I think from my perspective, as long as the soft landing outcome, the promise of that, if that becomes a reality, I think that markets seem to be embracing that, rallying significantly, and perhaps most importantly, broadening out. So to me, the big surprise yesterday, Josh, was probably the notion that the Fed will be cutting rates next year and, kind of even to a greater degree than anticipated. So that's the one area where I still have my antenna up because I'm a little concerned if they're cutting rates, it likely means that the economy perhaps is slowing more than anticipated. So that's the one kind of area, but it was much more dovish than I would have thought headed into that meeting.
Much more dovish to the point that now the market is pricing in more cuts. I mean, it's been pricing in more cuts than the Fed is implying, but it continues to do that here. So how much room for disappointment is there, not just around the number and pace of cuts, but to your point around why they would have to cut if the economy is worsening?
It is unsettling, Julie, from my perspective. And that is, I think the market should be kind of hoping for higher for longer. I think this notion that they'll be cutting rates, aggressively cutting rates, if that is the scenario, I think it suggests that the economy is slowing worse than anticipated, or there might be a capital market catastrophe somewhere. And those are two bad options for risk taking. So I think this is a be careful what you wish for moment for markets. So I would much rather the kind of promise of the soft landing scenario become the reality than the fact that the Fed is forced to cut rates to a greater degree than the market's anticipating. It's hard for me to envision this notion that inflation comes closer to the Fed target, that the economy just gently lands on the runway and we all go on our merry way as they cut rates. I just think that the risks are really skewed to the downside on that scenario.
And Mike, as you noted, you were surprised by that pivot that you heard there. I think a lot of people were. Did that change, Mike, then, as you were listening to that? Did that change, where you see opportunity in the equity markets and kind of just the near intermediate term here?
It hasn't changed it much. And we chatted about this the last time I was on. What's been fascinating is the impact that interest rate volatility has had in terms of on the market's returns, in terms of the stock market. And sure enough, here we're seeing that again as 10-year treasury yields are plummeting, real estate stocks, bond proxies are leadership, financials are doing well. So you are seeing that broadening, small caps are doing well, which is kind of consistent with the historical precedents that ultimately as interest rates fall, perhaps we get some normalization, some stability here in terms of the future path of monetary policy. You do see value stocks and small cap stocks rally. And sure enough, as this has been happening, Russell 1000 value has been beating Russell 1000 growth, and small cap stocks have been leadership. So it hasn't changed much of my thinking going forward.
Yeah, I'm really struck today by the outperformance of the Russell 2000 and just the huge gap. It's up 2.5%. compared with the S&P up 0.25%. So it's a big difference here today, Mike. What are you recommending in terms of strategy then? Do you go value, go small caps, and that's where you should be positioned kind of heading into 2024?
I think that's right. And again, I think this is really holding on tightly to this notion that the soft landing outcome is achieved. And again, I can't stress enough that a soft landing is a unicorn. It's rare. It has only happened a few times in the last, 50, 60 years. So again, this idea that we just kind of slowly, the economy slows a little bit as inflation comes in and the Fed has to cut rates in response to that gently. I do think that the risks are skewed to the downside, but the data suggests that that's the case. Retail sales, productivity gains, the job market, all of the data suggests we're trending towards that soft landing. So as a result, Julie, I think you're in quality growth and cyclicals, energy, financials, materials, technology, small cap stocks. They will all benefit in that soft landing outcome.
And Mike, when you say quality growth, what defines quality growth? What's the criteria that sort of defines that? And what are the ETFs if you want to play that theme?
Sure, Josh, I think you've kind of hit the nail on the head here, and that quality is in the eye of the beholder. So the way I think about it is stable earnings, healthy balance sheets, low debt to equity. They can self-fund, meaning they don't have to tap into the financing markets at higher rates now. Maybe they're paying or growing some dividends. So the kind of S&P Dividend Aristocrats Index, for example, is one of these kind of areas that we think fits that mold. The NYSE kind of technology leading index also is another area of quality growth. So XNTK, SDY, these are areas in our view that represent quality and in many instances some component of growth as well.
And what role do bonds play in all of this?
So it's interesting in that the fact that income has become more plentiful hasn't made the bond decisions any easier. So, I mean, bonds still play an important role in a diversified portfolio. And certainly as yields fall, those longer duration maturities have benefited. Most investors that we kind of work with seem to be barbelled. So they tend to have a lot on the shorter end of the yield curve, lots of liquidity, stable income, low volatility, very little interest rate risk, very little credit risk. And they're barbelling that with intermediate term positions in terms of intermediate treasuries or intermediate investment grade corporate bonds to kind of create that barbell, that balance between longer and shorter duration fixed income instruments. Now, Julie, the one quick thing I'll say here is that what's going to happen as we go to 2024, and is happening now, is that the threat of reinvestment risk is becoming the reality of reinvestment risk. And what I mean by that is as yields fall and investors' short maturity in fixed income investments mature, folks are now going to have to invest at lower rates. They're going to have to deal with that. And ultimately, they're tending to find more opportunities in traditional fixed income markets and maybe to an extent credit. So that also will continue, I think, as we head to 2024.
Interesting stuff as always, Mike. Good to catch up with you. Michael Arone, appreciate it.